in your exam. So first question here is from the November 2020 sitting. Like I said, it's a level 3 question, final level. And let's read the requirement. What's the requirement? It said, as a tax advisor, evaluate the proposed investment by the Singaporean investor and the tax implication of the various activities highlighted in the scenario. That is for 10 marks. So what they are saying is that we need to evaluate a certain proposed investment and then tell them the tax implications of all the activities in this question. So let's read through the question. Let's try and make a mental note of each area and what we need to discuss. And please keep it at the back of your mind. Like I keep saying, here we just don't solve the questions because you can find solutions online. The value you get here is how do you answer questions? And my recommended approach is if it's 10 marks, please be looking to make at least 10 distinct points. Let the examiner be able to segregate clearly, know clearly that, okay, he's made 10 points and he deserves 10 marks. Don't just write one big paragraph with all your answers in there. You won't score the marks, right? So separate your answers clearly. Make it clear that you are talking about a particular thing at a particular time. And in that way, you give yourself the best possible chance of passing that particular question. So here, we know we have 10 marks. We know we have quite a number of things to do in this regard. So let's start reading the question and picking out the key areas. They said, following the government's commitment to build one factory in each district in Ghana. Do we still have one district, one factory? I don't know. Yeah, right. Following the government's commitment to build one factory in each district in Ghana and its desire to ensure food sufficiency through the Planting for Food and Job program, an investor from Singapore intends to invest in shoe manufacturing company to be located at Accra. So, you see, and tax is interesting. Once I see manufacturing company, then I need to think about what the locational incentives for manufacturing companies. You know, manufacturing companies get a rebate based on where they are located. I'm sure all of us are aware of this, aren't we? All right. So, following the government's commitment to build one factory in each district in Ghana and ensure food sufficiency, an investor from Singapore intends to invest in what? Shoe manufacturing company. To be located where? At Accra. So hold on, if they are in Accra, do they get any special incentives? We'll find out shortly. In the Greater Accra region, he also considers starting a juice manufacturing company at Nsawam in the eastern region of Ghana in response to the investment drive of the government. So here the proposals are, he's thinking of starting a shoe manufacturing company in Accra, and he's thinking of starting a juice manufacturing company at Nsawam. So here, locational incentive wise, one is in Accra, Greater Accra Regional Capital. One is in Nsawam Eastern Region. It is not a regional capital. And I hope by mentioning this, I've drawn your mind towards the locational incentives for manufacturing companies. If you don't remember, it's fine. I will teach you how we get there. As part of the investment, he intends to incur the following costs and start operations in 2018 on either of the proposals, which is the shoe manufacturing company or the juice manufacturing company. So these are the costs you incur. Building 7.2 million, plant and machinery 11.7 million, furniture and fittings 180,000 cedis, computers 180,000 cedis. Additionally, he intends to recruit fresh graduates, which is why I feel this question is quite great, because by the time we are done, we'd have covered capital allowance, would have covered fresh graduate incentive, locational incentives for manufacturing. As you find out in the subsequent paragraphs, we'll see some elements of thin capitalization, we'll see some elements of unrelieved loss carry forward. So that's why I said level 2 candidates, all these topics are in your syllabus. But let's use a level 3 question to revise, and I think it will benefit both levels, because level 3 guys will get their own question, and level 2 guys, even though it's not your question, it is your topics from a higher level, so you still get to benefit, right? So he intends to recruit fresh graduates from the All Nations University College of Ghana. So there's something called the Fresh Graduate Incentive provided under Act 896, which I will also mention. Then it's further projected that in the first 3 years, that is 2018, 2019, and 2020, the business will incur 36,000, 32,400, and 18,000 losses, respectively. And you know, manufacturing companies are also entitled to carry forward their losses, right? Is it 3 years? Is it 5 years? We'll find out shortly. But let me give you a clue. Manufacturing companies are designated under the income tax regulations of 2016 LI 2244 as being a priority sector. So that should give you a clue. They'll get a higher number of carry forward period. Then the investor hopes to start making profit from the year 2021. He intends to borrow at 20% interest from his USA associate, amounting to the equivalent of 100 million Ghana cedis. The equity he intends to start with is 36 million cedis. So, with all this information, how do we proceed? So let's start, right? What do we need to know in this particular question? There are a number of areas that we have to cover. I'm sure you've realized, and it is a lot to cover. But let's use a structured approach, and I feel that's the best of ways we could actually cover a lot of ground in this question. So let's begin from the top. Let's try and take each paragraph and see what we can get from there, right? So here, let's start. The question is saying, evaluate the proposed investment. So this is question 1. So give me a second. Okay. So we say evaluation of proposed investment and tax implications. So we can have our first heading, right, which can say manufacturing company locational incentives, right? So we can say first point we are making is that the general corporate income tax rate in Ghana is 25%. Then we say, next point, however, manufacturing companies enjoy some location-based tax rebates, right? Full stop. These are shown below. So you can just have a simple table like this. Something of this sort. So let's just say location tax rebate, right? So we say first one, let's break it into two. We say regional capital into bracket what? Outside Accra and Tema, right? What's their rebate? They get a rebate of what? 25% of corporate income tax rate. Then the next one is what? Located in what? Parts of Ghana outside regional capitals. These will get what? 50% rebate of the company income tax rate. So we've given the general rule. Then we now have to apply this to the question. So next point we'll make is that what? Following from the above, remember they told us there will be a shoe manufacturing company in Accra and a juice manufacturing company in what? In Sanwem. So we'll say shoe manufacturing company in Accra will not benefit from any locational incentive. As such, the general 25% company income tax rate will apply to this entity. Then the next one is what? We say the juice manufacturing company located, no, not located, to be located, right? To be located at Nsawam, which is not a regional capital, so we'll say into brackets outside a regional capital will enjoy the, do you remember I said here what? 50% rebate, right? Will enjoy the, oops, let me change this. The 50% CIT rebate, full stop. So we say as such, their company income tax rate will be what? 12.5%. How do I know? There's simply what? 50% of what? 25%, which is the general. So they get a rebate of what? 50% of the general rate, right? So by doing this, take note, if they are giving you 10 marks, I've made a number of points here. So this is my first point. This is my second point. I gave them a table. I even gave them a third point, right? But let's keep going until we've spoken about all the issues in the question. So we are done with the locational incentives for manufacturing company. We've established that Accra Shoe Manufacturing Company will get 25%, and then the juice manufacturing company will benefit from 12.5% because they are outside a regional capital. So that will be it for the first paragraph. Next paragraph is saying, as part of the investment, he intends to incur the following cost and start operations in 2018 on either the shoe manufacturing company or the juice manufacturing company. And when I see building, I see plant and machinery, I see furniture and fittings, I see computers, what comes to mind? Capital allowance, right? So the next thing we need to talk about is what? Capital allowance, right? Capital allowance. So we'll say Ghana's Income Tax Act 2015, Act 896, provides for capital allowances for what? Depreciable assets used in business, right? So in business, okay. Obviously, this can be found under what? Section 14 of Act 896, as well as the third schedule of Act 896. So we can just say the capital allowances are computed on the below basis. So let's just give them a quick table. So we say class and then what? Rate. So we have class 1, class 2, class 3, class 4, and then what? Class 5. So we know class 4 is what? 40% on what? Reducing balance basis. Class 2 should be what? 30%, also reducing balance. Our class 3 should be what? 20%, reducing balance. Class 4 will be what? 10%, but this time is what? This is straight line basis. Then class 5 is what? Divided by the useful life. Obviously, it's also what? On a straight line basis, right? So this is straight line, right? So this is our table. You don't need to give them the details. You tell them that there are 5 pools or 5 classes, and each one has its own special rates. Okay, right? So now that you've done this, then you can now apply the rates you have given here to the question. So we'll say that the building of what? 7.2 million will be a class, what we can guess? Class 4 asset, and will be granted capital allowance at the rate of 10% on a straight line basis. Simple, right? If you've made another mark. Next is what? Okay, speaking about the building. So next is what? We've done this. Let's talk about plant and machinery. The plant and machinery of 11.7 million will be placed. Who can guess? Is it class 2 or class 3? Anyone? Please type your answer in the comments. Class 2 or class 3? I'm waiting. Class 2 or class 3? Yes? Plant and machinery. The answer is class 2. Remember I told you plant and machinery used in manufacturing would be class 2. If they said it wasn't a manufacturing company, then fine, it could have gone to class 3. But once it's a manufacturing company, remember that plant and machinery used in manufacturing activities will be class 2. If you don't know this, please go and watch the videos on capital allowance. If you know it, don't bother. It means you're in good shape, right? The plant and machinery of 11.7 million will be placed in the class 2 pool of assets. You can even flex the examiner and even let them know, because this is a manufacturing business or a manufacturing concern, right? This will then be granted capital allowance at the rate of what? 30% on a reducing balance basis. So the next should be what? Our furniture and fittings here. So we say what? Next, furniture and fittings of Ghana cedi 180,000, which pool? Class 3, right? Will be placed in the class 3 pool of assets and will be granted capital allowance at the rate of anyone 20% on a reducing balance basis. The next is what? Computers. We all know that is class 1. So computers of what? 180,000 cedis will be placed in the class 1 pool of assets and will enjoy capital allowance at the rate of what? 40% on a reducing balance basis. And that will be it for capital allowances. So as you can see, we've also made a number of points on a capital allowance, right? You've given them the rates, you've told them where you can find capital allowance and all of that. So building class 14%, plant class 2, 30, okay? Furniture and fittings class 3, 20, is it? Yeah, 432. Computers class 1, 40%, reducing balance. Good. Let's keep going. Then they gave you one nice short paragraph here, sweet and short. He intends to recruit fresh graduates. Are you aware that in our law, we have something called a fresh graduate incentives? Anyone aware? If you go to the sixth schedule, schedule number 6, right? The sixth schedule of the Income Tax Act, Act 896 of 2015, specifically paragraph 8, you see a certain nice section there headed employment of graduates. So what that does is the law is encouraging companies to employ fresh graduates to run business. Obviously, this will help reduce unemployment in the country. So this is kind of a way to get companies to what? Pick up more unemployed fresh graduates to also reduce the burden on government. So we say the next is what? Let's just call it the fresh graduate incentive, right? So we'll say, if you don't know, this is fine. If you don't know it's in the sixth schedule, please don't stress yourself, okay? You can't come and kill yourself. Just say the sixth schedule of Act 896 provides for a fresh graduate incentive as shown below. The company will benefit from an additional expense deduction of the wages and salaries of these fresh graduates in line with the proportion of the company's workforce that is constituted by fresh graduates. So what I'm trying to say here is that if you employ a certain proportion of fresh graduates, we give you an additional deduction of their salaries and wages as what? A CIT deduction. Take note, you get a deduction for their salaries anyways, but this is giving you an additional deduction to encourage you to what? Recruit more fresh graduates, right? So what does the law provide for? Let's create a table. So something like this, because we told the examiner that we've shown it below, right? So we'll just say percentage of workforce. Let me even do it like this. Let me write it first. So percentage of workforce that are fresh graduates. And then the next column can be what? Additional expense deduction. Okay, that's more like it. Okay, right? So if you have what? Up to 1% of your workforce being fresh graduates, you get what? 10% deduction of their salaries and wages. If you have what? Above 1%, but not more than 5% of your workforce, then what do you get? You get 30% of their salaries and wages as an extra deduction. If they are what? Above 5% of your workforce or more than 5% are made up of fresh graduates, then get what? A open 50% of their salaries and wages as an extra deduction, right? But here, the question didn't give us any specific amounts for us to find and proportion. They didn't give us the total staff strength. They didn't give us number that are fresh graduates. So we can't advise them on where they will fall. But here we've given them the juice, right? We've given them what they need to know when it comes to fresh graduates. So you're done. This will give you another, I'm sure it should give you like what, 2 or 3 marks, 1 mark, I don't know. Right, but let's keep going. Next line, it is further projected that in the first 3 years, right? So in the first 3 years, that is 2018, 19, and 20, it will incur 36,000, 32,400, and 18,000 losses. So if a company makes losses, how are these treated, right? So we just come in and say next is what? Unrelieved loss carry forward. Right? That's why I said this was a good question, because it's helping us revise so many things at once. So when I saw it, I was like, let's do this. Right? So unrelieved loss carry forward. So we are saying that what? Manufacturing companies are designated as what? Priority sector companies. For those who are interested, this can be found in what? The Income Tax Regulations of 2016, LI 2244, right? It gives us a specific list of those who are priority, and we find manufacturing companies there. So we say, next point to make is that what? As priority sector companies, manufacturing companies can carry forward unrelieved losses for a period of what? 5 years. Take note that those who are not priority can carry forward their losses for what? 3 years, but manufacturing and other priority sectors can carry forward their losses for 5 years. So let's apply this towards the question. We say Therefore, the losses of 36,000, 32,400, and what? 18,000 can be carried forward for the subsequent 5 years and will be deducted in the order in which they are incurred. What this technically means is that it will be on a first in, first out basis, kind of. So the 2018 loss will be carried forward for the next 5 years, so 19, 20, 21, 22, 23 in that order, right? Until there are taxable profits to subsume these losses, or the year lapses, whichever one comes earlier, right? So this is it for the loss carry forward. You just tell them that the losses can be carried forward for a period of what, 5 years, and you're done. Really, one paragraph, one short paragraph. And the last paragraph we have is on something called thin capitalization, right? Something called thin capitalization. So thin capitalization. And we've treated this under the Advanced Income Taxation series, so please do check it out if you have no idea what this is, right? But the whole idea of thin capitalization is that what it is a way of ensuring that what companies do not over leverage, right? So I'm sure you know that what interest is tax deductible. So if we let companies alone, they probably borrow and borrow and borrow and borrow and borrow. So the thin cap is a way to prevent companies from over borrowing, such that we are saying that we'll only allow you an interest deduction, and in some additional cases, what, a foreign exchange loss deduction that relates to some class of debt, right? And these deductions will not exceed a threshold of 3:1, being the ratio of what, your debt to equity. So we're saying that we allow you to have at least, or at most, 3 times your debt, 3 times your equity being your debt in your company's capital structure. Anything above this threshold, the corresponding proportion of interest expense and foreign currency exchange losses will be disallowed as a deduction. So let's write: the Income Tax Act provides for a thin capitalization ratio of what? Of 3:1. Then we say being the ratio of debt to equity. You've made your first point. So we'll say the company has equity of what? You can see here 36 million, right? So 36 million, and debt of what? You can see here he intends to borrow at, yes, 100 million, so in debt of 100 million. What I'm saying is that your debt to equity ratio should not exceed 3:1. That is, if we multiply your equity by 3 times, right? That is the maximum amount of what debt you are allowed to have, right? So let's see if this company has breached the threshold. So we can say let's just say 3 times equity will give us what? So let's just do 3 times what? 36,000. So we'll say give me a second. 3 times 36,000 will give me Ghana cedi 108,000. What this means is that what? 108,000 is the maximum amount of debt this company can have without what triggering anything capitalization restriction. This question says their debt will be what? 100,000. So they are within the 108,000 cap. Do you get it? So here there's nothing to worry about at the very basic level, right? So we'll say that since the debt amount of Ghana cedi 100 million. Okay, this is in millions. Okay, please add 3 zeros here. Let me write this 108. So this is Ghana cedi 108,000,000. Okay, of 1 million, 100 million, sorry, does not exceed the 108 million 3:1 limit, no fin capitalization restriction will apply in this case. Then if you want to score prize winner marks, you can just add this point that however the interest rate would have to be at arm's length in order to avoid a transfer pricing adjustment by the Ghana Revenue Authority. All I'm saying here is that they are saying they are going to borrow at what? 20%. But take notice, from a USA associate, it means they are related parties, right? So the GRO will be interested to know, is this 20% a commercial rate? Is this 20% rate at arm's length? If I went to the bank, would I get the same loan at 20%, or you are giving him a more favorable loan or a higher rate if you want to, depend on your transfer pricing objective, right? So if we can do this in the exam, ladies and gentlemen, easily you are scoring 10 marks. You've made enough points, right? Spoken about as you can see, so many things, right? So please, if you can do this on exam day, that is some cool 10 marks for you. So let me highlight the things we've done so far. Give me a second. So we started by looking at what? The locational incentives. Then we came to what? Capital allowance. Then we spoke about capital allowance was quite long. Then we came to fresh graduate incentive. We provided the examiner with a table. Then we spoke about unrelieved loss carry forward. Then we now ended with what? Think capitalization. If you can do this, ladies and gentlemen, this is a cool 10 marks for you. Let's move on to the next question. So in question 2, it's still level 3, but very much examinable level 2 because it's on the what? Concept of also losses from investment and business being what? Offset where possible, right? If you go to section 17 of the Income Tax Act of 2015 at 896, it talks about losses from business or losses from investment, right? So the rule there is that generally, right? Generally, a loss from a business may be deducted in calculating your income from an investment, but a loss from an investment cannot be deducted from a what? Business income. I'll say that again. The general rule is that if you have an investment loss, right? If you have an investment loss, you cannot deduct it from business income. Investment loss can only be offset against what? Investment income. However, if you have a business loss, right? If you have a business loss, you can deduct that business loss when you are calculating your income from investment. Take note, business loss can be deducted from both business income and investment income. However, investment loss can only be deducted from investment income, but not what business income, right? So that is all this question is seeking to test you. You can see they gave you ABC Limited declared profit or loss as follows. 2017, they made a business income of 100,000 cedis. Then they made investment loss of 50,000 cedis. 2018, they made business loss of 40,000 and investment gain of 120,000. So the question is just going to ask you, what can you offset against? So that's all. So it's for 3 marks, but it's worth picking up because it's something you can all do, right? So here, let's take our second question. So this was question 2 for us. This was May 2020, level 3 advanced taxation, question 4B for 3 marks, right? Okay, so let's write the general rule first according to the law. So we'll say section 17. Once again, please, if you don't know the section, don't stress, right? Of the, just write the income tax provides that, right? So then of the Income Tax Act 2015, Act 896 provides that an unrelieved loss from a business may be deducted in calculating income from an investment, but an unrelieved loss from an investment shall be deducted only in calculating income from an investment. So you stated a rule. Now, because the question said explain, so let's say the rule. Let's apply it to the question. So we'll say in 2017, there was a business income of 100,000 cedis and an investment loss of what? 50,000 cedis. Here we have investment loss and we have business income. Remember I told you can't deduct investment loss from business income. So we'll say that full stop. Say the investment loss of what? 50,000 cedis cannot be deducted from the business income of what? 100,000 cedis. So we said I cannot be deducted, right? So that is it. You can't deduct. Okay. The next one is what? In 2018, there is a business loss of what? 40,000 and an investment income of 120,000 cedis. Remember, I told you that if it's this way, then you can what? Offset. We'll say the business loss can be deducted from the investment income of what? 120,000 cedis. But take note that, watch here, there was a loss of 50,000 in the previous year, right? That we couldn't offset from business. So now that we have a gain, you can carry forward, right? So we'll carry forward the 50,000 loss from 2017 to 2018. So we say the unrelieved investment loss in 2017 of what? 50,000 will be carried forward to 2018 and used to reduce the amount of what? Investment income. That means investment income accessible to tax. So that's it. This is a 3-mark question. Don't come and write a thesis. We are done. I think we've even written more than enough, right? We are done for this question. Right. So remember, the rule is that what? When it comes to losses, an unrelieved loss from a business may be deducted in calculating income from an investment. So take note, if it's business loss, you can deduct it from investment, right? But an unrelieved loss from what? An investment shall be deducted only in calculating income from an investment. So if you have investment loss, right, you cannot deduct the investment loss from business income. Investment loss must be deducted from only investment income. However, if you have a business loss, you can deduct that business loss from what? Investment income. Take note of that, right? That's the rule we've tried to test here. That's all, really. All right. Next question. This was from May 2017. Back then in that syllabus, when we didn't have 2 tax papers, so it was 1 tax paper. So technically, they were testing both level 2 and level 3. But once again, this is something that is in both exam syllabus, and I think we need to look at it on something called finance cost limitation. Finance cost limitation. So for those who are interested, you can find this in section 16.16 of Act 896. Once again, it talks about what the limit on deduction of finance, what cost or financial cost. So here, what do we need to know? They are saying in this question that the requirement is what? Compute the financial cost to be allowed in the 2016 year of assessment. This is for 6 marks. And then advise management on the above results for 4 marks. Okay. So this is question 3. Right. So first of all, what is this rule even about? Right? What does this rule talk about? Let's read the question first anyways. So XYZ Limited runs a business with a basis period from January to December each year. The following information is relevant to its business operations for 2016 year of assessment. Chargeable income from business operations is 40,000. The chargeable income was arrived at after, take note, after the following adjustments were made. Financial costs incurred on hedge transactions, 150,000. Financial gain from her transactions of what? 60,000. Then on this, you are required to compute the financial cost to be allowed and then to advise management. So here, what must we know, or what does the law specifically say about this topic? Now, it's a long wording, right? So I'm going to try to reduce it to a formula for you to make your life easy, right? What this provision seek to do is that the amount of financial cost a company can deduct when it comes to arriving at the assessable income, we are trying to limit it so that they don't have an excessive amount of finance cost, right? So the rule generally is that the amount of financial cost other than interest, so without talking about interest, right, that can be deducted in calculating the income of a person from an investment or a business conducted for a year of assessment will not exceed the sum of two things. So let me write this down in a formula for you to make your life easy. So finance cost limitation, right, equals, right? It said the law says shall not exceed the sum of two things. The sum of one, a financial gain derived by that person that is to be included in calculating the income of the person from the investment or business. So FCL, which is finance cost limitation, will equal what? Finance gain. Please, this is my formula. So trademark, copyright. Okay. All right. Shall not exceed the sum of what? The finance gain derived by the person and 50% of what? The chargeable income of the person for the year from the business or investment calculated without including a financial gain derived by the person or deducting a financial cost incurred by the person, right? So I'll call this 50% of what? Chargeable income star. That will mean adjusted chargeable income. So let me make this simpler. Finance cost limitation will equals my finance gain plus 0.5 CI star. So I'll say where FCL equals what? Financial cost limitation. If you use this formula, there's no question on this topic that will ask you that I can't do, right? People struggle with the interpretation, but please use this and you'll be fine. Where FG equals what? Financial gain. CI star equals adjusted chargeable income. So remember, the said we should use the adjusted chargeable income. So it means we have to find it, right? So I'll show you what to do shortly. So in this question, you can see they gave us what? Chargeable income here, right? Let me use this. They gave us chargeable income to be what? 40,000. So let's say chargeable income equals 40,000. Then the chargeable income was arrived at after the following adjustments were made. So financial cost 150,000. So we have financial cost, that is our FC. This is given to be what? 150,000. 150,000. Then our financial gain. Financial gain, that is our FG, equals what? From here, 60,000, right? So equals 60,000. Take note, the question said the chargeable income was arrived at after the following adjustment. So it means this chargeable income here, right, is after adjusting for what? Financial gain and finance cost. And adjusted chargeable income here is what? The law defines that as what? The chargeable income of the person from the year calculated without including finance gain and cost. So it means we need to strip it from this. We need to what? Add back and less respectively, right? So what must we do here? It's quite simple. We have something to work with, which is what? This relationship here. right? So let's come and determine the element. We have this thing, we have the finance gain here, this one, so it's not a problem. All we need to find is what the CI star, and then we are good to go. So let's find CI star, that's chargeable income star, adjusted chargeable income as I've written here. CI star is adjusted chargeable income, right? So let's find that. So our CI star essentially going to be what? Our CI, which is our chargeable income, right? Take note that to arrive at chargeable income, what would you do? You would have what? Added what? Finance gain and deducted finance cost. Normal P&L, right? You add income and less expenses. So if you want to reverse, what do? You will deduct what? The gains and add back the cost. Please listen. You agree with me, to get the chargeable income, what would you do? Ordinarily, you add all incomes and less all expenses, right? So if you are working backwards to strip these figures out, what would you do? You add back expenses or you add back finance costs, and you now rather what? Less the finance gain. So our CI star would be what? The CI they gave us in the question, which is here as what? 40,000, right? Plus what? Okay, let me change the pen. Plus what? My finance cost, because I'm adding that back, minus my finance gain, because I'm trying to deduct that. So my CI star becomes what? 40,000 plus 150,000 minus 60,000. See, if you master this formula I've given you, to be honest, right, there's nothing that will beat you on this topic. Just have a framework and look for questions to practice. So 40 plus 150,000 minus 60. This will end up giving you 130,000. So I know my CI star is 130,000. Can you all see that once I have my CI star here, I can now come and find what? My finance cost limitation, because I have my FG, right? And I have CI star. So I'll say finance cost limitation will equal what? Remember I said it's what? It's FG. So what's my FG? Let's even write it again. Equals finance gain plus what? 0.5 CI star. 0.5 CI star. If you can reduce some concepts to formulae like this or relations, it makes your work easy, make your life easy, right? So this is what I've done to understand it, and it works for me, so you can do it as well. So here, what is finance gain? It's given here as what? 60,000. So let's just 60,000 plus 0.5 of what? 130,000. So this will end up giving 60,000 plus what is half of 130? Easy peasy. That would what? 65,000. So when I add 60 plus 65, that should give me what? 125,000. So my FCL equals 125,000. So I'll say, therefore, the financial cost limitation will be 125,000 Ghana cedis. We are done, right? So that gives us 6 solid marks, 6 good marks. Let's do the advice to management. That's also very easy. All of this can be found in section 16. So anybody who has not read this section will be in trouble. But then again, if you have watched our videos on business and company income tax, I think it's in 2 or 3 parts. Everything you need to know, like nothing has been left out, is in those videos. So if you don't know what I'm talking about, if all of this looks like stars to you, please go and watch, right? It's covered everything. Just cover your back and make sure that as you're going to the exam, your base is strong, okay? So we've covered finance cost limitation there, just that we didn't have an example in that video. It just gave you the principle of law. Here you have an example. So now that you've seen the example, please go and watch it together with other things that are very examinable, right? So the next thing to do is the advice to management, right? So they said what we need to give advice to management. Now, what the law says is that any finance costs that you incur, that is denied a deduction because of this formula we just mentioned, right, must be carried forward, right, for the following 5 years, and will be treated as what incurred in the order in which they are what incurred. So take note, if there is a limitation of finance cost because of this thing we've done here, any excess that is denied a deduction in that year will be carried forward for 5 years. So advice to management is very straightforward. So we'll say a financial cost for which a deduction is denied may be carried forward for a period of 5 years of assessment and treated as incurred during any of these 5 years in the order in which the costs are incurred, something like this, right? Then we say, let's now relate it to the question. I was about to say the company. Let's use the company's name. So we say XYZ Limited incurred financial costs of what? 150,000 cedis, right here, right? 150,000. But we are saying that what? We said the financial cost limitation here is 125,000, right? So they spent 150,000, but they can only get what? 125 in this year, right? So let's even incurred financial cost of 150,000. The financial costs limitation is, however, we got what? 125,000. So you can see there's an excess 25,000 they cannot deduct. That's the part I'm saying has to be carried forward for 5 years, right? That extra will be carried forward for 5 years. So we'll say the extra financial costs of 25,000 cedis is simply the difference between what? The two, the 150 and the 125. So the extra financial cost of 25,000 that was denied a deduction will be carried forward for the next 5 years of assessment. Yeah, so if you can do this, 4 marks, you're done. Right, really. You're saying tell management what the implications of this are. That's all you've done, right? And that should help you with this particular question. Let's move to our next question. Here let's solve something which is quite popular, examination of accounts. This is where they give you information to compute what taxable profits or chargeable income, and then you use your knowledge of the law to work this out. So this is from November 2019. Vice level 2. I think today we've been doing level 3 throughout, which obviously will benefit the level 2 guys immensely. But now let's give them their due, right? So let's do a level 2 question. This was question 4 of November 2019. So Valentine Ghana Limited is a producer of love greeting cards, and the following was extracted from its financial statement for the year ended 31st December 2018. Right? Good. What must we do here? So they give us a number of information here. This was a very short question because it was just for 8 marks, so nothing to stress you. The point of this is to teach you the technique of doing an examination of accounts and not really to just pick a full question and spend 2 hours doing it, right? All right. So here they said capital allowance for the year was 204,000, agreed with the GRA. The figure for repair and improvement include an amount of 33,150 being the cost of erecting a new gate. Now this is a capital expenditure and that has to be what? Capitalized and granted capital allowance, but they have expenses, so we need to disallow or add it back. The next is that 50% of the other income amount, which I don't know what it relates to yet. They're saying was personal rental income of the managing director. So the managing director is making rental income on his own personally, and he's adding that income towards business income. We need to deduct it from it. Then they're saying 1/3 of the vehicle running expenses was expended on the personal car of the managing director used for the company's operation. So here they're trying to trick you. Some students will see managing director's personal car and then they'll disallow it, but they are saying they've emphasized here that this was used for company's operation based on the company's policy, right? Then the requirement is what? Calculate the chargeable income of the company for the 2018 year of assessment, right? Okay. So in questions like this, what do you do? Okay. This is our question 4. So in any typical examination of accounts question, what do? You start with what? Your net profit. So we just say, let's create 2 columns. The examiner has recommended that students should write what the name of the company and the heading. It's in the examiner's report, you can check. So Valentine Ghana Limited. He's saying students miss out on easy marks by not taking these simple available marks. So just write the company's name and write what you are doing. So they said determining what chargeable income or calculate. So we just say computation. Literally just repeat the question, right? Of chargeable income for the 2018 year of assessment. That's it, right? Then let's create 2 columns. So Ghana City. You always start with what? Net profit, right? One trick or one tip you may want to use is, it's only the CIT that I've seen test this, Chartered Institute of Taxation Ghana, but maybe you never know. Try and do casting. What do I mean? So quickly, if you pick your turnover 7.14, you less 5 million, and you add these 2 guys, would you get 2.2? And if you less 1.9, would you get the 346,000? Right? You can quickly check. But I know this is balanced, so we don't need to stress. But if it wasn't, then you need to adjust for that extra by either adding or lessing, depending on what the variance. But here, we just say what? So say net profit per account. Was it? Is what? 346110. So 346110. That's all. Right? Then we'll go through the question and what? We disallowed things that shouldn't be there, and what we allow things that should be allowed, really. All right, so let's run through the notes first to see if there are any specifics. So for example, we've been given capital allowance. We'll deduct that later. We've been given repairs and improvement, and they said that figure includes some 33,000 that should be what? Disallowed. Then we have rental income. and vehicle running expenses good. So when we see them, let's remember. First thing here, taxes paid. This amount here, taxes paid, it should be disallowed. Why? The Income Tax Act has clearly stated that this is what the law clearly calls it an excluded expenditure under section 130, right? So it says any tax paid under the Income Tax Act will be what? Excluded. So let's add, or let's make it like this. Say add back taxes paid 2017. What's the figure? 289,000. So we add 289,000. So we know when you're done, you can highlight it to kind of clear it. So this is gone. Electricity bills paid. This is an expense that is incurred wholly, exclusively, and necessarily for the business. So what we will allow it. Next, wages and salaries of how much? 255,510. Hold on, was there a note about wages and salaries here? No, so we allow that as it is wholly, exclusively, and necessarily incurred. Rent and rates of what? 170,000. I don't remember any note on rent and rate. Is there? No, there isn't, so we are fine. That is also allowed. Traveling expenses of 144,330. That is also allowed. Office expenses of 68,760. Was there something on office expenses? Vehicle running. No, so that's also allowed. Then vehicle running expenses of what? 174,930. So if you come to note 4, they are saying 1/3 of the vehicle running expenses was expended on the personal car of the managing director, right? But here they said used for the company's operation based on the company's policy. So I'm sure if you've read the policy, right? Or to be more specific, they are saying that this car was used for the company's operation, right? So let's say you don't have the company's policy. Let's say you've not read it, right? But if it was used for company purpose, then this implies that the car, even though it's not for the company, has been used wholly, exclusively, and necessarily for the business. So we have to allow that whole amount. So don't let the fact that it's a note make you think that you need to disallow it. Okay. The next is what? Depreciation. Please, depreciation is clearly stated under the law, section 130 as what? An excluded expenditure. So we need to disallow it. So we add back depreciation of what? 149,940. Okay. So this guy can also go. The next one, penalty for late filing of statutory returns. All penalties and fines are disallowed. Okay. So we'll say penalties and fines of late filing. What's the figure? 61,880. So we have to disallow this as well. Then provision for doubtful debts, general. Those are also disallowed because they are general provisions. Specific provisions may be allowed, but general provisions are disallowed. So we say provision for general doubtful debts. I figure that's what? 154,020. Let's keep going. So let's disallow this as well. Stationery is allowed. Medical expenses allowed, unless there's a note here that says no, nothing. All right, cost of servicing is allowed. Sundries is allowed. Audit fees is allowed. Communication expenses is allowed. So let's go to the notes now. They gave us capital allowance. I'll learn that very soon. Okay, they said the figure for repairs and improvements include an amount of 33,150 being the cost of erecting a new gate. So let's go and look for repairs and improvements. Where are you? What's repairs and improvements? Okay, they didn't mention, but they said it's in the question. So it includes 33,150 being the cost of a new gate. If you are erecting a new gate, that gate is now what? An asset that must be capitalized. So we need to what? Add it back here and grant capital allowance. So we just add back cost of new gate. How much is it? 33,150, right? So we can add these up. So that gives me, to calculator, 289,000 plus 149,940 plus 61,880 plus 154,020 plus 33,150. This will give me 687,990. Then do you remember this note that said 50% of what the other income was the personal rental income of the MD, managing director? So we come here, you can see other income here of how much? 156,000. They are saying 50% of that figure was from his rental income. So we need to deduct that. It's not business income. So we need to less rental income of MD. So this would be what? They said 50% of that figure. This figure here is what? 156,400. So let's find 50% of 156,400. That gives us 78,200. So we can deduct 78. Now let's even do it like this. 78,200. Then we also less what? So we less. Then we have add backs here. So we less capital allowance now, which they gave us. So you take note that in some questions, they can ask you to compute capital allowance yourself, right? They'll give you the pool balances, additions, and all of that. Here, they just give us a figure to be 204,000. This is a gift, to be honest, right? So let's add them up. So 204,000 plus 78,200. That gives you 282,200. So now let's add everything up. Our profit of what? That is 346,110. 346,110 plus 687,990 minus what? 282,200. 282,200. That'll give me 751,900. Okay. So this will give us 751,900. And this is what? Chargeable income. And if you can do this, you get 8 marks, right? Now let's look at the final questions, which are nothing big. Once again, they are both testable for level 2 and level 3. So B, no deductions are allowed for domestic or excluded expenditure incurred by a person in the computation of assessable income. Required, identify 4 items that are domestic expenditure for 4 marks. Identify 4 that constitute excluded expenditure. Ladies and gentlemen, if you go to section 130 of the Income Tax Act, the full list is there, right? The full list is there. So let's quickly run through, right? So I is for what? Domestic expenditure. So now domestic expenditure, there are a number of them, right? So any expenditure, that is what, I think you guys should write this yourself, right? Listen to me and write. Alternatively, either I look at section 130 or or watch our videos, because it's just a thing to list, right? So let's not waste time on this. So check our videos on business and company income tax, or check section 130, whichever one comes first. If you're on the WhatsApp group, remind me. I can drop a screenshot of the section 130 to save all of us time. So please, right after here, remind me on the WhatsApp group. I will post a screenshot of this as well, if that works for all of us. So let me read them out. So domestic expenditure, let me open the act. It says any expenditure that is incurred in maintaining the individual, including the provision of shelter, meals, refreshment, entertainment, or other leisure activities, that is domestic expenditure. The next is what? Any expenditure incurred by the individual in commuting from home. Your transport from home is domestic. The next is what? Any expenditure incurred in acquiring clothing for the individual, other than clothing that is not suitable for wearing outside of work. So any attire, any work that you, any clothing that you wear to work is domestic expenditure, unless that clothing is something you can wear outside work, like factory overalls and related stuff. The final one is what? Any expenditure in educating the individual, other than education that is directly relevant to a business conducted by the individual and that does not lead to a degree or a diploma. This is what also domestic expenditure. So these are the ones the law provides for really. So let's look at excluded expenditure. For excluded expenditure, we have quite a long list. First is what? Any tax payable under the Income Tax Act is excluded. Any bribes and expenditure incurred in corrupt practices is excluded expenditure. Any interest, penalty, and fine paid or payable to a government or political subdivision of a government of any country for breach of legislation is what? Excluded expenditure. Expenditure to the extent incurred by a person in deriving what? Exempt amount or final withholding payment. Then retirement contributions, unless they are included in calculating income of an employee. Then dividends of a company are also excluded. And then what? Depreciation of a fixed asset will also be excluded expenditure. If you can list any four of these, you get 8 marks. That's a lot of marks, right? So please make sure you get this list. It's in the videos on this topic, and you can also find in section 130 of the Income Tax Act. Take note that the depreciation of fixed assets was inserted by Amendment Act, right? So you might not find it in original Act 896 as well. Okay, final question, and then we can wrap up. It says what? Explain briefly the taxation rules governing research and development expenses, right? So what are the rules for R&D? So this for research and development, research and development expenses, these can what? What's the taxation rule? Simple. The law says what? All research and development expenses that meet the requirement of being wholly, exclusively, and necessarily incurred may be deducted, or into brackets are deductible, irrespective of whether the expense is of a capital nature. So it means for research and development expenditure, whether or not they are of a capital nature, they are what? Deductible. They can be deducted, right? As long as they are wholly, exclusively and necessarily incurred. So this is really the answer you need to write, right? But the law gives a definition of research and development expenditure, so you can add that if you want, right? Let's do that. So we say research and development expense includes an expense incurred by a person in the process of developing the business of that person and improving business products or processes. Really, right? That's the law goes on to say it excludes expenses that are what included in the cost of an asset and all of that. But the key thing you need to mention is that what research and development expenditure that are wholly, exclusively, and necessarily incurred may be deducted, whether or not they are of a capital nature. Right. So this is it for this particular question. Let's wrap up today's session. Really, as usual, if you have any question, please do not forget to leave them in the live chat, and I will definitely respond to you. So this has been it for day 3 of our crash course series. We've attempted to do something on research and development. We've done finance cost limitation. We've covered some capital allowance, some locational incentives. What else? Let me see. We've covered some examination of accounts. We looked at finance cost limitation, treatment of unrelieved losses from business and investments, fresh graduate incentive, carry forward of losses, staying capitalization, and all of these, right? That's been a lot that we've done today. So my recommendation to you is for these principles, they are a lot, right? But once you know them, you know them. So please ensure that at least at the minimum, everything we've covered in our business and company income tax series of videos, please make sure you know them. Minimum, right? Because those things are highly testable and they would definitely be in your exam in one way or the other. So let's bring day 3 to an end. Day 4 of the crash course series, very interesting. Please don't miss it. We're going to cover VAT, that's value added tax, including NHIL and get fund levy. We'll cover withholding VAT, that is withholding on VAT or withholding on VAT. Then we'll cover customs. We'll cover excise duty. These are the things that sometimes when they come in the paper, students don't know what to do. But it's guaranteed that in your exam, at least one of these things will come. Because the question must test some direct tax as well as some indirect tax. So please ensure that you are here on Thursday at 6 p.m. so that we go through day 4 on these topics of VAT, withholding VAT, customs, and excise duty. So it's been a long day already. I guess some of us are already tired. So please, let's call it a day. I'll end today's session here. I wish us all the very best as we prepare for our exam. And let's remember that we can, we will, and we must. So please, let's all have a great evening, and I will catch you on day 4. Bye-bye, everyone.